Okay, and I'll do my best to get these up in a timely manner for you. But let's just go ahead and for module 6, guys, okay, I am going to ask that you look at module 6 by quickly making flashcard for all the formula that are in here, okay? I don't think that the examiners are going to spend a lot of time, for example, asking you how to calculate annuity present value using a formula, okay? They're probably more likely going to give you factors, and you're going to have to know how to choose the correct factors. And we're going to actually look at example of some problems here tonight when we're looking at net present value calculations, where they're going to ask you to select the correct factor. And when you start to look at the things that are in module 6, it starts to become just a matter of a listing of formula after formula after formula. And I just don't feel that I have any value to add to just asking you to flashcard formula. And I'd much rather us spend our time together here getting into module 7, where there's actually something for us to talk about. However, I do want you to, on your own, look at these formula, make sure you have flashcard in your stack for these formula, and maybe look at the examples together on your own. But I don't want to do that here together, where I'm just listing off formula to you, and then, we're maybe practicing with an example, and then a formula, and then an example. I don't think you need me to walk you through that, okay? So what I want to do is jump us all the way to module 7, where there's actually something for us to talk about beyond just babbling on about listing of formulas, okay? You will probably see some questions in your homework. I'm sure you will for module 6. Take a quick look at those. If after you look at the problems for module 6, you sit there and you say, well, gee, maybe I should have added a couple more flashcards, or I need to, really get more comfortable with some of these flashcards to be able to answer these questions, spend that time to do that. And I think you'll be in good shape for the chapter module 6 material. So I want to start at module 7 tonight, okay? And when we take a look at module 7, what we're going to be starting with is different, really, tools that are used to make various decisions. Particularly, we're going to look at net present value, internal rate of return. Now, they do have this discussion here about option pricing models, and I don't know that the examiners are going to get too off into asking you about this. This is really more something that is relevant to stock options that are discussed in the FAR exam that you heard about in intermediate accounting. All we really want to do here is understand the factors that go into an option pricing model. So a few years back, FASB decided that entities should record expense for the cost of options that they offer to their employees. The idea being that the employee is working very hard, they're staying with the company because they know that they're going to have some stock option down the line. When people work hard with an incentive like that in mind, that should be recognized in the financial statements as an expense, as those options are earned by the employee. But in order to do that, we have to have a way to value those options. And that's what we're talking about here, okay? So an option is something that is going to allow an employee to buy a stock at some point in time at a determined price, and those options have value at the time that they are awarded to the employee. So we can sit here and we can see that there is this Black-Scholes model, which is a commonly accepted model for valuing options. Now you come over and option price calculators are widely available, and you don't have to use the Black-Scholes, but Black-Scholes pretty much is a pretty commonly accepted one, mainly because it was called out by FASB as a particular model that could be used. Now, when the FASB first came out with the, consideration of exercising the expensive models, of options, everybody was like, oh, the Black-Scholes model has all kinds of problems and blah, blah. And it was particularly people that didn't want to have to record the expense of options. And it was typically people that were of a CEO, CFO level, because their options were probably a little more lucrative than anybody else's. And they didn't want to see these huge expenses hitting their income statement. And so they were the ones that were sort of criticizing the Black-Scholes model. So that was a lot of the discussion. And so I could see the examiners maybe giving you an essay question where they're asking you, hey, pros and cons of the Black-Scholes model. And that's what we're really going to focus our flashcards on here. So some of the factors that go into the Black-Scholes model would be the current price of the stock, the option exercise price. So even though the stock may be selling for, $30 a share, maybe they're going to say the exercise price is $35 per share, with the notion that that stock is going to increase over time because the employees are going to work very hard in order to get those options at $35 a share, when by the time they're exercising the option, for $30 a share, whatever it said, by the time they exercise the option, the stock is trading at 40. So it's trading currently at 30. The option price is 35, with the anticipation that someday it'll go to 40. Now we'll consider the risk-free rate of return, the time until the option will actually expire, and then some measure of the underlying risk of the specific stock that we're talking about. Assumptions underlying the Black-Scholes model, let's go ahead and look at that. Stock prices behave randomly, the risk-free rate and volatility of stock prices. There are no taxes or transaction costs. The stock pays no dividend, and the options are European style, exercisably only at maturity. Okay. Now, limitations of the Black-Scholes model, and I could see again an essay question asking you, what are the inputs? What are the assumptions? What are some of the limitations, right? 3 different things that you would be addressing in an essay question. So I want you to go ahead and have a nice flashcard made up around this. And again, when you look at your stack of cards, although I don't think Becker does a good job of giving you, was there a question? Of giving you a flashcard on these kinds of things. So, you may not have these, but take a look and see what you have for, I'm just gonna go ahead and mute all. You can unmute when I ask you to. See what you have in your flashcards for this. I doubt that you'll have something that's quite like this, but if you do, you don't have to remake the flashcard, right? Okay. So despite it's being used quite a bit here, right, it does have some limitations. Okay. So it may differ from real prices, assumes instant costless trading. The model tends to undermine extreme price movements, underestimate, I should say, and the model is not acceptable to pricing American style options. I'm not sure what an American style option is, but just flashcard that. Okay. Okay, good. Now you come over and valuing options using the binomial model. And the assumptions of binomial model are perfectly efficient stock market, and the underlying price will move up or down at certain points in time. Those are called nodes during the life of the cycle. Flashcard that. Okay. Note, guys, that they are not going to ask you to calculate the price of the options on the CPA exam. So all we're doing here, we're not doing calculations. We are simply putting in different factors that feed into these option models, and then the benefits and some of the risk to these different models. The benefits of the binomial model is it can be used for American style options, and it can be used for stocks that pay dividends without modifying the model as necessary. Okay, so just have some in your head, some flashcards, and then in your head on your exam, obviously, that go through some of these very, high-level theoretical discussions. Okay, valuing debt instruments, and that really is how we come up with the value of a bond. Okay, and when you come up with the value of the bond, and accountants do that because we need to sit there and figure out what to debit and credit when a company issues bonds, it is simply looking at the bond as cash flows and taking the present value of the principal when it will repay, the present value of the interest payments, and then adding those together. If it is more than face, that's a premium. If it's less than face, that's a discount. I think if you've come this far, you know how to account for bonds in a very simple manner and just flashcard the particular elements that go into that, which is basically the present value of the interest and the present value of the principal on a bond. And for some reason, I feel like I'm seeing things. Yeah, I am seeing things on my glasses. So let me take a quick second, guys, to get that off of there. Any question? Okay, good. Let's go ahead then and let's take a look at the next page and the valuing of tangible assets. Okay, tangible assets being what? Being property, plant, and equipment. Okay, and there are 3 different methods that I'm going to ask you to flashcard what the 3 different methods are. And then we're just going to see what they say in the first line of each one of these very quickly. The cost method is whatever you paid for that. The value of the asset is based on the original cost paid to acquire the asset. Okay, again, we're not talking about valuing for accounting purposes here, right? We're talking about valuing for just measuring the value of a particular asset more from a management standpoint than from an accounting standpoint. Okay, market value method requires that we look at similar assets in the market to find a comparable value. So maybe we have a stock, and that particular stock, our particular stock isn't traded, so we can't really use some of the elements that we would use in the capital asset pricing model, but we might be able to look at a stock of some company that is similar, right? And then that would be a way of valuing our stock, even though we're not trading that stock. Appraisal method, of course, this is not stocks per se. This might be more property, plant, and equipment, but we could look at something that is very similar, say a piece of equipment. Okay, appraisal value, and under the appraisal value method, professional appraiser determines the value of an asset, and that might be an acceptable way to come up with the market value. Okay, again, we're not worrying so much about our accounting for these assets as we are just how will we value them for different, financial decisions. Okay, but you can flashcard those 3 methods. Okay, good. Now let's come over and let's take a look at for valuation using accounting. I'm not going to go through each one of those. Those are self-explanatory, but valuation using accounting estimates. And when we're preparing accounting estimates, we could use historical information. Okay, GAAP requires that we have, for example, an allowance for uncollectible accounts, and we could just go ahead and analyze, our collectability over time on accounts receivables from customers, for example. That would be using historical information. Market information, we talked last time about using the lower of cost or market, right, for our LIFO, lower of cost or net realizable value for all other inventory methods, but again, using market information. Expected use, okay, that's common for depreciation. Estimates from experts, okay, for example, attorneys will give us the, considered losses on pending or threatened litigation. Okay, now you don't have to flashcard those examples, but I would like you to flashcard the different methods that we are considering here and listing here for accounting estimates. Okay. All right, guys, nothing very fancy there either, really just a list of definitions, no calculations, okay? All right, so with that, let's go ahead and let's jump into module 8. And now we're going to start to have some calculations that we'll be doing to figure out, basically, we're going to look at 3 different methods. There's a couple of other ones that come in here, but we're primarily going to focus on net present value method. We're going to focus on internal rate of return method, and we're going to focus on payback method. And all 3 of these are used for a corporation to decide whether or not a particular project is something that they should undertake or not. Now, they may have more than one project that they're considering, and if that's the case and they have a limited amount of capital, it can also be used not only as a screening tool, but as a evaluation tool where we will decide which particular investments we'll go for. The higher the net present value, we'll take that particular investment over one with a lower net present value. We'll continue down the list until we run out of capital to invest. That's really where we're going in this module. Okay, so capital budgeting is a process for evaluating, selecting long-term projects for the firm. Now, as we go through and we consider these cash effects, okay, we're going to look at cash flow effects to do this, okay, and as we look at these cash flow effects, that's really where the decision is going to be decided. We're going to be looking at the net effect. Net effect is the what? Cash inflows minus cash outflows. That's going to give us the net cash effect. And since these investments will go over some period of time, we will have to use net present value calculations. And again, these factors that go into these present value calculations, every problem I've seen, they give you the factors and you have to sit there and try and figure out which factor to use. They don't make you derive the factors, which is all about what they're really talking about in that module 6, that I do want you to look at that material on your own, but I don't think you need to nearly spend the time that you would spend actually using those numbers in the calculations. Okay, so we consider the inception of the project period 0. In other words, the present value factor will be 1. There'll be no discounting for any cash flows at the inception of the project. That's really what that time period 0 sounds like, some science fiction there. Basically, what they're saying to you is there is no discounting for any cash flows at the inception of the project. Now, as we start to look at the cash flows, a common mistake is to forget about the working capital use. Okay, so here's what happens. Give you an example. Let's say we're going to be involved in some kind of project where we're going to need a bunch of sand, okay, to be able to produce this product that we're talking about producing. So what happens? We're sitting there and we're deciding, well, should we, buy this sand refiner that we're going to need in order to do this? And as part of this sand refiner machine that you're thinking about investing in, they will sell you the sand, and the sand is going to be held in these large containers, okay? And you're going to need to make a deposit for the containers, $100,000 deposit at the beginning of the project for the containers. And then at the end of the project, say 5 years from now, you give them back the containers, they give you back the deposit. Okay, well, that's a tie-up of working capital over the time of that investment, and you need to consider the fact that that working capital is coming out at the beginning. And then the common mistake that I see for my intermediate accounting students when we talk about this, and my cost accounting students, when I teach at the university, these classes, they always forget to bring the working capital back at the end. That's an easy mistake to make, and the problem will definitely have a choice in there that anticipates that mistake. Okay, so let's just go ahead and take a look. And we have the situation where there's a cash outflow that is recognized at the inception of the project because part of the working capital of the organization will be allocated to the investment project. Again, that's that money that goes into the deposit, say, in the little example that I'm giving, $100,000 at the very beginning. And then, and I just want you to draw an arrow down and make sure that you flashcard this whole notion that it's a cash outflow at the beginning. And then you need to consider it a cash inflow at the end. Okay, and so just come down, 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 down. And don't forget that a working capital commitment that was recognized as a cash outflow at the inception. Okay, and don't worry that they're putting the word indirect in front of it. I wish they wouldn't put that indirect in front of it because that just makes it seem harder than it is. Okay, and we're not talking about indirect cost here. We're just talking about a cash flow at the inception, and then it'll be a inflow at the end of the project, okay, when the working capital is released. However, since that cash isn't going to be released in our little example until, say, that cash for the deposit and be released until, say, 5 years later, that one will have to come out, and we will have to, when it comes back, it'll come out at the, without being discounted. But when it comes back, we will have to discount that to present value. So don't forget that you would have to discount it to present value. Okay. Now, when we start to look, coming back up, another factor is what happens when you dispose the asset that you are acquiring. So we acquire a piece of machinery, we use it for 5 years. Presumably, we're investing in it because it's generating some cash flows, and then we'll dispose of that asset at the end of the 5 years or whatever it is. Well, if we sell the asset, then we're going to have what? We're going to have some cash that's going to come in from the sale. And if we sell it at a gain, there's going to be what? There's going to be a tax effect to that gain. So we're going to have to show the cash inflow net of the tax that would be associated with that gain when we sell the asset. Okay, if it's a loss, then we're going to have what? A tax benefit. So we sell it for more than book value, that's a gain. Tax, we're going to have to consider the tax considerations. We sell it for less than book value, that's a loss, and we'll have to consider the tax implications of that tax saving. So if the new asset requires the sale of an old asset, the cash from the sale of the old asset reduces the new investment's value. If there is a gain or loss for tax purposes exist, there will also be a corresponding increase or decrease in income taxes. Okay. And so you can go ahead and just remember that you need to consider the tax considerations. If we abandon the asset, okay, then the net salvage value is treated as a reduction of the initial investment in the new asset, and the abandoned asset's book value is considered a sunk cost and therefore is not relevant to the decision making. However, the remaining book value is deductible as a tax loss. Okay, so I'm just pointing this out to you to get it in your head that you're going to have to be thinking. I don't really want to flashcard anything here. You're going to have to be thinking through the tax implications of the gain or loss on the sale or the loss on the abandonment of a particular asset. Okay. Okay, good. Now you come over, and when we look at our operation, okay, again, depreciation shields and creates a tax shield ongoing. And again, they use that word indirect cash flow effects. Again, I wish they wouldn't use the word indirect, but depreciation shields a certain amount of our income from tax. And so we need to consider that when we're considering the after-tax cash flow. Okay, so you come back down, and again, disposal of the investment at the end of the project. Okay, and if the asset is sold, there is a direct effect for the cash inflow. and they could be certain direct expenses associated with the disposal. If the asset is scrapped or donated, then there would be a tax savings because we are essentially not getting any money in for that, but we are recognizing a loss by just scrapping the asset, and we'd have to consider the tax effects of that. So the most important thing on this page really is what? Remembering what to do with the working capital, and have you make a flashcard of that, because that's easy to forget. And then for the rest of this, it's what? Just think through everything that's going to happen, the abandonment or sale of that item at the end, abandonment or sale of any asset we're getting rid of at the beginning because we're replacing it with a new asset, and then thinking through the tax implications of that. Okay, so let's just start to look at and start to get comfortable with the figuring those after-tax cash flows, since we know that we need to do that consideration. And I'm going to ask you to really focus on method 2 here. Method 1 to me just seems a little cumbersome, and so I don't like it. If you look at method 1 on your own and you like that better, go ahead. But I like method 1 better, which is multiply the net operating cash inflows by 1 minus the tax rate. That gives us what? The after-tax cash flows. But you have to add the shield associated with non-cash expenses such as depreciation. Okay, again, the tax shield is because we've got a new asset that we're depreciating, and we're going to be able to take that tax expense. That does what? That lowers our net income, and that lowering of net income means we don't have to pay as much tax. We're calling that a tax shield. And then, of course, you have to sum those two amounts. And I don't know that we need step 3, since it said in step 2 to add the tax shield. So maybe it wasn't clear that by saying add, we meant to sum those two. Okay, so you just take a look at this method 2 using these facts. Annual cash flows 40,000, depreciation is 10, tax rate is 40. Okay, so in order to sit here and get the after-tax cash flows, we take what? We take the 40,000 and we multiply it by 1 minus the tax rate. That means that we're going to have to pay 40% tax on this annual cash flow. So we're going to get to keep what? 60% of it, right? If you got to pay 40% out in tax, you get to keep 60% of it. But we have to consider what? We get to take additional depreciation here of 10,000. Okay, so that means that we get to shield $4,000 of income from tax. And so the after-tax implications of this investment are 28,000. Question? Okay, so that's something that, I gave you a flashcard on what you're supposed to do up here. I really consider a lot of these calculations for capital budgeting to have more to do with weightlifting than jogging. What does that mean? You got to practice with these and get stronger at these, and eventually you get good at them. Some things that you just have to memorize, say the formula, that's more like jogging. You just have to repeat it. Whereas these, you've got to practice with these enough so that you're getting stronger, so that you then get very good at these by the time you get on the exam. But I don't think any of this is going to be particularly difficult for you. Okay, good. So I just want to go ahead and jump us down to these specific methods now, using discounted cash flows. And as I mentioned at the beginning of class here, we're going to focus on 3. First, let's focus with net present value. Okay, now net present value is basically the most commonly accepted method these days, because it allows a company to consider different rates of cash flows, different amounts coming in different years, perhaps changes that are going to happen in the depreciation and whatnot. Whereas when we talk about the internal rate of return, that gets a little bit difficult because we typically have to use just one rate. Now, the desired rate of return for a project, okay, is something that will be given in the problem, but it's worth tying what we have said earlier in the chapters here, that the weighted average cost of capital is often the hurdle rate that we will use to decide whether or not we're going to accept the project. And it turns out that rate, which again will be determined by management to a large extent, that rate is often the weighted average cost of capital. We'll be using that for all of our discounting that we're using in the net present value method. Okay, obviously we're having to discount. It has the word what? It has the phrase present value in there. Okay, so you come over and you start to take a look, and basically when we calculate the cash flows, we will ignore depreciation unless there is a tax shield associated with that, and there probably will be. Okay, so again, if they're giving you a problem, they're saying, and I'll just give you an example to make that a little clearer. Let's say they tell you that there's $30,000 is going to be the net income of the project. Okay, it's going to generate an additional $30,000 of net income, the project will. But they tell us that in calculating that, they had revenue of 40. We'll say revenue of 50. And then they have expenses, say salaries of, I don't know, now I'm getting myself screwed up in the numbers here, salaries of 25. And depreciation of 5,000. So how am I getting 30,000 net income? Okay, that's easy enough to fix. So we're saying that the net income is what, 20,000 there, right? Okay, so what happens? To calculate the cash flows, they say ignore depreciation, consider it properly. To get the cash flows, you'd have to do what? You'd have to add back that depreciation, because that's a non-cash factor, right? Okay, now this is ignoring depreciation. I mean, excuse me, ignoring tax, not ignoring depreciation, ignoring the tax. We would actually want to figure what the tax shield that depreciation has and bring that back in as part of the calculation as well. And we'll see some of those in some of the examples we're going to be coming up with here in a second. Okay, good. So let's come over and let's see how we will interpret the net present value method. And this is probably the most important part that we definitely do want a flashcard, because even though we may know the mechanics of calculating the net present value, if we don't know what the results mean, we're going to be in trouble pretty quickly. Okay, so a positive or zero net present value means we should make the investment. Okay, if we have a positive or zero, they don't say zero because probably I guess most problems don't have, in most real life situations, don't have a zero net present value, but a positive or zero net present value means make the investment. A negative net present value means do not make the investment, step away from the investment, because the rate that we will use to discount everything was our required rate of return, say the weighted average cost of capital. Negative means you haven't hit that rate of return that you're looking for, so this is not a good project. Okay, now you could also have the situation in which you are looking at several projects, okay, and you may have several with positive net present value, but you don't have enough investment capital to take all of them. So what would you do? you would rank them with the highest net present value first, use so much capital on that highest one. Then if you still have some left over, the second highest net present value, the third, and so on. And you just keep going like that until you ran out of capital. We're also going to talk about an index that can be used as well. We'll talk a little bit about that too for ranking multiple projects. Okay. Again, you don't have to worry about calculating the rates. Those are determined by management. And again, we have learned that that often is the weighted average cost of capital. Okay. Okay, good. Let's go ahead and let's just take a look. Let me just quickly say, you don't have to flashcard, but if they say the rate is being affected by risks or inflation, fine. Then go ahead and add any risk or inflation factors that they're asking for there. So, I mean, if they get silly and say, well, they typically use this, but for this project, they want to add so many percent for risk or so many percent for inflation, go ahead and fold those into the rates that they're giving you in that problem. Just add them in there. Okay. Okay, good. So let's come over and again, the beauty of the net present value method is that it could be that we will have to use different interest rates on a project, okay, or different discount rates, I think is a better way to say that, in a project, and that's perfectly fine, and that is really what makes net present value superior to internal rate of return, that the internal rate of return is really assuming one rate throughout the life of that project, and that may not be the case. So, okay, so that's something you can flashcard. Okay, let's look at this problem here and see what we come up with. Okay, so we've got this facts, and the facts are that McLean Inc. is considering the purchase of a new machine that will cost $150,000. Okay, and I'm going to go ahead and make sure we've got some of these numbers highlighted as we're going through. $150,000 is what we're going to pay. That's the initial investment, and basically they're going to look and see if we want to invest in this, if this project has what? A positive net present value, right? Or zero net present value. If not, we're going to reject it. The machine has an estimated useful life of 3 years, okay? And assume for simplicity that the equipment will be fully depreciated for tax purposes, 30% in the first year, 40% in the second year, and 30% in the third year. Okay, so we've got different depreciation rates that are being used both for book and tax purposes, and this is kind of what is a benefit of the net present value method, is it deals better with these varying cash flows over the years. Okay, the machine will have a $10,000 resale value at the end of its estimated life. The machine is expected to save the company, there's our cash inflow, $85,000 per year, and we have a 40% estimated income tax rate, and the hurdle rate is 16%. Now, in this particular problem, the way they're laying this out, they gave us factors only at the 16%. Sometimes I see questions that will give you different percentages to try to confuse you. Well, maybe I should use a different percent. If they're telling me that the hurdle rate here is 16%, then I would use the factors at 16%. But notice they're requiring that I know present value of $1, okay, that I have the factors for that and know when to use that. Present value of $1 assumes what? A one-time cash flow. Okay, can you think of any cash flow here that's going to be one time? I mean, you can only sell a piece of equipment once. Okay, that's a cash flow that comes in just one time. Okay, present value of an annuity considers what? Considers a stream. That's a stream of cash flows. And in this particular problem, we have what? Well, they told us it's going to save the company what? 85,000 per year. That's a stream of cash flows. Okay, so you need to know how to apply which factor to which cash flow, right? That's the challenge, not the derivation. This is not, the CPA exam hasn't gotten to a point yet where they're going to ask you to bust out calculus to start, calculating a net present value table, but a present value table. But they would give you factors like this, and you have to kind of understand how the factors relate to the cash flows that are being communicated in the problem. Okay, now you come over and you take a look, and they're going to first do the tax shield. Okay, and the tax shield is what? The annual depreciation for year one will be 45,000. For year two, it'll be 60,000. Year one and three, because they said for year one and three, the rate is 30%, the fact pattern. And then we have a tax shield at the 40% rate is 18,000. And then they told us for year two, the depreciation rate is 40%. That's not the tax rate, that's the depreciation rate, right? Okay, and then we have the 40% there. So that's the 24,000 is the tax shield. Okay, annual savings, and again, annual savings is 85,000, but you need to take that net of tax. And then you're going to have the fully depreciated asset at the end that you sell for 10. And we have to consider what the tax implications of that. You could take 10,000 times 60%, or take the 10,000 minus the 40% tax, however you want to do that. I like to take 10,000 times 0.6 on those, because I'm looking at saying, okay, after I pay the tax, I'm going to get to keep 60%. Notice, guys, to calculate the tax shield, though, you use what? You use the 40% rate. So be careful. That's an easy mistake to make. If we're talking about after-tax cash flow, it's the 60% that we're applying to the amounts that are coming in. If we're talking about depreciation shield, we simply use the tax rate on that. And then we go ahead and we set these up. And I kind of like this setup. It's not a bad idea when you're doing a problem like this. They give you scratch paper on the exam, guys. So while you're practicing your homework, you should be having a piece of scratch paper there and set up these net present value calculations just like this. It is impossible, nearly impossible, to sit there and do this purely into your calculator. Now, on the exam, they do give you Excel. So you may want to practice while you're sitting there practicing your homework, maybe putting, numbers like this into Excel spreadsheet, because they do give you that tool on the exam. So it really depends on what you're good at. I like to just write it down longhand, but I'm not that good at Excel. So that's sort of why I write them down. You may want to go ahead and just use Excel for this. Okay. So what do we have? We have the 150,000, and that's what I was saying, no discounting. When you use a factor of 1, that's not discounted, because that money is coming out now. Year 1 means near 0, means now. Okay, then what? Then we go ahead and we have the depreciation tax shield, the annual savings, net of tax. We add those together. That's the 69,000. And we have to, in this case, use the present value of a one-time payment for all these. You're saying, well, John, but the 51,000, why can't we use the annuity? The problem is that we have what? We have different tax shields for different years. Where's my tax shield? We have different tax shields for different years. So we are stuck not being able to use that present value of the annuity factor for our cash, for our net cash calculations, because there's different amounts for different years. So they just use the factor for year 1, year 2, for year 3 for the different years as they go along. Okay, so they're picking those up from there. Okay, present value of annuity factor really wasn't useful for this problem, because you had the different tax shields in those different years yielding different after-tax cash flows, right? And so you go ahead, you multiply those, you then subtract or I guess add, since we're treating the 150,000 as a negative number, right? That's going out. You add the inflows to that. This has a positive net present value. Are we happy or sad about this project? We're going to do this project, right? Question. Okay, so you can see why I didn't have you flashcard a lot of that stuff about advice about how to go through these problems. It is a weightlifting thing. You know, you got to practice with it. You do it the first time, it's a little bit heavy, right? You do it the second time, it's not as bad. You do it the third, fourth time, you are a champ at these things. That's the way you've got to, you know, build yourself up some endurance as you go through these problems.
Quick question, Professor.
Yeah.
So the annual savings of 85, why didn't we get the present value of those?
We did.
We just get the annual savings, what do you call this? Tax
Annual
effect.
savings was 85,000, right? But we don't get to keep all that. We got to send 40% of that to the IRS, don't we?
Right, and so we have like 51,000 savings every year, but that's like an annuity, right? So are we not supposed to get the present value of that to
Well, we
calculate?
did, but we had to do it in a funky manner because of this stupid situation with the different tax shields.
Right, different tax shields, I understand, but the annual savings. So
Let me ask you a series of questions here so we don't get ourselves lost. Do you understand that these three numbers down here were a sum of the 51 and the tax shields?
all right, because that's where we're using the, okay.
Right.
Okay, got it.
Yeah, okay. Yeah, some of these numbers, the way they throw them around in some of these examples, it's pretty easy to all of a sudden find yourself going, huh, what am I doing? So just ask me if you're not seeing that, because sometimes they go a little fast, or I guess you'd say, well, you went fast, John. But the way they kind of just blah, 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 these numbers down, it gets kind of hard to follow sometimes. So if you're not following, just let me know.
I got it definitely now, because at the bottom you're getting the net present value anyway. Okay, individual.
Correct. And we had to use, now you're right. Let's say there was no tax shield.
Mhm.
Let's say there was no depreciation tax shield in a problem. Then you're right. Then to get the inflows, I'm taking the 51,000 and I'm multiplying them by the present value of that annuity factor, right?
Right.
But the tax shield is what blew that out of the water, because they had a different. Now, if the tax shield was the same each year, and again, I could have used the present value, but I'd have to remember to add those two numbers together. But then I could have used the present value of the annuity factor.
Yeah, or I could have computed it like the depreciation and then add the present value of the 51 for the next 3 years.
You could have come up with the present value of the depreciation tax shield using the factor for each year, and then use the present value of the annuity factor for the 51,000. I think that is more dangerous than the way they did it.
Okay.
When I say dangerous, I mean danger of pressing the wrong number or something on your calculator as you're doing it.
Right, right. Okay.
Yeah. So I think this is a safer way of doing it. That's why I said practice setting up. To me, the hardest part is you got all these pieces of information, and I don't see how somebody sits there with a calculator just piping in all the information that needs to be considered and think they have a chance in hell of the right answer showing up on the other end. I think you got to sit there and write yourself something down or put it into the Excel tool on the exam to make sure you're keeping all the numbers in front of you properly. Okay, good. Let's come over and see what they tell us about net present value. And the advantage is, okay, and when they're talking about advantage, really, they're talking advantage over, you know, in internal rate of return and payback method, the other methods that we're going to talk about. The limitation here is considered the best technique, the net present value method for capital budgeting is limited by not providing the true rate of return on the investment. Net present value method nearly indicates that an investment will earn the hurdle rate. That rate that we use to discount everything was based on, what we have said we will require as a rate of return for a particular project. And the positive is indicating, okay, the rate of return is higher than what was indicated there, was higher than what we were saying the hurdle rate was, but it doesn't actually give you the rate of return on that. So flashcard that. Okay, let's look at capital rationing. Okay, now, assuming we had unlimited capital, then we'll go ahead and all investments with a positive net present value should be pursued because we're getting the return and we have unlimited capital, whatever that means. I mean, everything has a limit, but if they're saying you don't have to worry about capital limits, then take all the investments with a positive net present value. If we had limited net present value, then we're going to basically have the option of taking the limited, we're going to rank those. I don't know what the hell they're saying in that paragraph underneath there, so I'm not going to try to interpret that. But let's say if we have the capital being limited capital, boy, they must have got paid by the word here and decided not to make any sense in the process. Okay, I mean, give me something I can, work with here. Okay, but let's just let's write our own book here for this. This is just nonsense. Okay, so we have limited capital. Okay, go ahead and rank projects from highest net present value, highest positive, of course. We're only going to consider positive net present value. That's it, with highest positive net present value to lowest until you run out of capital. Okay, so for limited capital, you can just do that and you can flashcard that. For limited capital, rank projects from highest positive net present value to lowest until you run out of capital. Now, they do finally give us this notion of a profitability index. Okay, so, if a problem isn't giving you a profitability index, you do this. If they're asking you about profitability index is the ratio of the present value to net future cash inflow to the present value of the initial investment. So let's go ahead and flashcard that. Okay, present value of cash flows to the present value of the initial investment is our profitability index. And then when we apply that, we're going to sit here and the profitability index measure cash flow return per dollar invested. The higher the profitability index, the more desirable the projects. Projects that meet the screening criteria, positive net present value, are ranked in descending order by their profitability index. And then the limited capital is applied in order. So this one is a little more sophisticated than what I had you write in the margin a minute ago, and that now it's saying, well, yeah, this project maybe has a higher net present value, but it's going to eat up all of our capital, and the amount of capital that it's eating up isn't worth the positive net present value as much as something with not as much capital being used and not as high net present value, but higher relative to the amount of the initial investment. So let's just look at this question, okay? And they give us the initial investment. And then they give us the present value of the future cash flows, and they're using that profitability index, so they're dividing these, okay? And then we need to go ahead and rank these. So which one has the highest profitability index? Looks like what B does. So B looks to be number 1. That's requiring what? An investment of 4,000. Good, not using up too much of our capital. What's the next one? The next one is E. Okay. Okay, that's going to take up 25,000. How much do we have to invest here? 50,000. Okay, so far we've used up what? 29. Okay, and then you come over to the next highest. Next highest is this what? 16,000. Okay, so that one would be third. Okay, and then we've got what? Then we've got fourth, and we've got fifth, and just eyeballing the numbers, we're going to run out of some capital here, right? So you would just start looking. Okay, yeah. B is one, our first one. I'm going to do that one. That's 29,000. You add the 16, that's 45. And then we don't have another project that only requires 5,000. So we stop there. Okay. Okay, so that's a good discussion in net present value. And let's go ahead then and let's take a look at some questions that contemplate net present value. And my mouse is playing little games with me, so hang on, I'll get the poll up. Try this. Okay, guys, I'm going to go ahead and end the poll. So please make your choice if you haven't already. Okay, and all right, pretty good. We had a few folks came in here towards the end. That percentage was hovering more up around 85% till the very end, but most of us got it right at 78%. And they're saying to us that the original fair market value of the old equipment is not relevant. In other words, that really is a sunk cost and it's not relevant to our decision. Let me stop sharing and get that poll out of the way, but let's take a look at this. Which of the following does not affect the decision? Current disposal price of the old equipment. Yeah, we're going to get some money that's going to come in. That's going to decrease the initial investment. But remember, again, we'd have to consider the tax implications of that. So if we sold it a gain or loss, we'd have to consider that. Cost of the new equipment. Absolutely. I don't know if anybody picked that one. That choice C, that's sort of what we're evaluating against everything else of the cash inflows and whatnot that'll come in. Operating cost of the new equipment, again, it is what? It is the net cash flow. So even though we're buying a piece of equipment, if we have to spend some money on maintenance for that equipment or something, then whatever money it brings in is going to be reduced by what we have to pay for the maintenance or these sort of things, right? So that would be considered. Original fair value of the old equipment. No, what we paid for it 10 years ago or whatever doesn't matter, except that, and there's a little bit of a flaw with this question, that we would probably use that fair value of the equipment when we bought it, which would be the original fair value, unless we bought it for more or less than the fair value, which would be kind of weird. And that we would use that to calculate any gain or loss on the equipment, and then that would be relevant to the after-tax cash from the sale of it. So not the best question in the world, because B could potentially, if one really thought about it, have an implication here. Okay. Okay, good. Let's take a look then. There's no questions on that one. Let's take a look at the second one. Something going on, guys? I'm only seeing about 60% of us participating here. Okay. Okay, good. Let's go ahead and let's end the poll and let's take a look at this one. And I think the reason so few of us got it right, 38% of us got it right. I mean, excuse me. No, okay, 50% of us got it right. It's choice D here, sorry. But only 50% of us got it right. And there was quite a few for A. And I think the reason that we have 38% looking at A is that we have sort of, sat here and hypnotized you into, the net present value method uses the firm's cost of capital. And so you read that and it's choice A, and you maybe made the mistake of not reading through the rest of the choices. What movie was that? Don't do that. Don't just read that first choice and think that you're going to get the answer right. Okay. You always, I don't care if you're willing to give your firstborn that A is the correct answer, read through the rest of the choices. And we said when we were going through that material that if there's a certain degree of risk for a certain project, then you would adjust accordingly to that project. We said you could adjust for that. You could adjust for inflation, right? Okay, so maybe that's what happened why 38% of you looked at A, maybe you didn't read the rest of those. That's a common mistake, particularly if you get stuck on the exam with time and you start, wanting to give an advantage to the first things you see. A good way to practice sometimes with these questions to avoid making that mistake is start from the bottom and go up. So you kind of almost physically train yourself not to make that mistake of, just choosing that first one because it sounds good, because they like to do that. They'll put something that sounds pretty close to the right one first, even though it's not right. Okay. Okay, good. Let's go ahead and let's take a look at our next question. Okay, let's go ahead and take a look at this one. Looks like almost everyone's had a chance to try it. And good, we got a good response rate for this one. Correct response rate is, oops, sorry, if you didn't see it, it was 88%. I think I forgot to put the results up there. So 88% of us got it right. Couple of us picked choice A. If the net present value of the capital project, capital budgeting project is positive, it would indicate the opposite, right? Not that the present value cash flow exceeds the present value cash inflow. Present value of the cash inflow exceeds the present value of the cash outflows. It's the opposite. So you might have gotten twisted back on that. And then if you also didn't read through to the bottom, you then see, well, wait a minute, rate of return for this project is greater then the discount percentage that was used, rate used in the net present value calculation, that's exactly what that means. Okay, so you would have maybe had a chance to see that D was the correct answer if you read all the way down. I don't know why there's being choices being given again. I guess because I put back up the poll or something. Okay, so I'm just going to go ahead and end that poll. And let's go ahead and look at the next question. I'll give you about 3 minutes with this one. I'll give you another minute. Okay, guys, go ahead and make your best choice. We're coming up on a little bit more than 3 minutes now. And, you know, the mantra that I give you on these questions is that you should be working on them about 1.5 minutes, but that's more of an average. I would say a question like this is a good 3-minute question. You should never go longer than 3 minutes on any one question in the CPA exam, because that's a good way to blow up your time budget if you start doing that. So this one, though, if you're taking the exam, might be about 3 minutes. Okay, so most of us got it right, though, which is good. That's 69%. That's a pretty good percentage for a question like this. But let's go through this one together, because I think that half the battle here is knowing how to set this thing up. And so when I look at this question, I'll kind of read through it. Once I kind of understand what's going on, quickly read through it, and then I try to start to pull numbers out of this thing and set them up accordingly. So Salem Company is considering a project that yields an annual cash inflow of $420,000 for years 1 through 5 and a net cash inflow of $100,000 in year 6. The project will require an initial investment of 1.8. Salem's cost of capital is 10%. Present value information is provided. And we need to know which of these to pick up for which of the cash flows. So I always like to start off with the easy one. I know that the 1,800,000, and what I'd like to do is I set these up that I have the cash flows. Okay, I have the present value factor that I'm going to pick up. And then, of course, I know I need the present value to actually be able to answer the question. So then, I'll go ahead and I'll have the column that's going to be the interaction between the cash flow and the present value factor. And now it's my job to align the cash flows with the right present value factor. But in the case of the 1.8, there is no factor. I mean, that money's coming out now, isn't it? So the present value is 1.8. So if you didn't get that, and I know a couple people picked D, maybe because you discounted that 1.8. I don't know. I was trying to figure out how anyone got D. Maybe that was the reason, because you discounted that one that comes out now. Okay. Then I look at the net cash inflows. Okay. And they tell me that there's 420,000. They tell me that that's going to be relevant for years 1 through 5. And I look and yeah, thank you very much, God. They give me what? The factor for 5 years of an annuity, because it's a stream of payments. So I take that 420 and I'm going to multiply that. I pick up the factor 3.79. I do the math on that with my calculator. And I get 1,591,800. And then, the beauty of net present value is that we can deal with different cash flows from different years. And so this 100,000 is really like a one-time deal that's going to come in year 6. So I have to pick up the factor for that. So I multiply that times 0.56. Okay. And when I do, I get what? 56,000 for that. So I have this negative 1.8. I add in the positive cash flows that are going to come in years 1 through 5 and year 6. And I get 152,200, which is choice C, which I think most of us got. Question? Not 800, but 152,200, which I think most of us got. Question? Okay, good. I think you see, guys, for these net present value, and really we're going to continue that same mode as we get into this next module here. It's really about building up muscle tissue around these problems. I mean, it's not like it's conceptually hard, but you've got to practice with these things so that you feel comfortable with the process of getting through and picking out the right information to answer the question and arraying it properly. But I think that this area is probably going to be pretty strong for you on the exam. Okay, which is good because it's a good, 5 points on the exam. Okay, let's take a break right here as we head into the next module, module 9. We'll come back. Let's make it pretty much 7 o'clock that we will reconvene and work through our last module, module 9. I'm going to pause the recording. Somebody please remind me about that, to start that back up again when we return. Resume the recording for us, and let's go ahead and let's take a look at module 9. And the first thing we're going to do is really continue the discussion of the net present value method. And we're going to use it in the context of basically the decision to buy or lease a particular asset. And we don't need a whole big decision tree for that. Okay, so should we buy or lease is really what we're talking about here. And we're going to use net present value and compare the option of leasing versus the option of buying. And we'll select the option that has the highest net present value, of course. Now, when you're looking at this, going over to the next page, and you're trying to make that decision, because we already know we're only going to pick things that have a positive net present value. So I don't know why they have to repeat all that now. But when we're looking, assuming both the leasing and the buying has a positive net present value, we'll pick that with that financing option with the higher net present value. So we're going to have to discount the cash flows to each financing option. Preferred financing option is the one with the lowest net present value of cost. Well, look, let's just stick with this idea of going with the project that has the higher net present value, because the cash inflows are going to be the cash inflows. And so we'll subtract the cash outflows versus the two financing options, and we'll pick the option with the higher net present value. Okay. Relevant cash flows, if you're buying the asset, just as we've seen, is the purchase cost for the asset, tax savings from depreciation, and the scrap proceeds. Okay, if we're leasing the asset, then it is going to be the lease payments and the tax savings on those lease payments. Okay, so let's just look at this example here. Notice I didn't even have you flashcard that, because again, it becomes a matter of repeating with these types of problems, and then just getting comfortable with picking up the relevant factors and setting them up in a manner to where you can answer the question. So Boulder Inc. is considering the acquisition of a new machine, either through a lease or by purchasing the asset. The asset will cost $200,000 with a scrap value of $25,000 at the end of year 2. Of course, that assumes that they're going to buy it in that scenario. Operating inflows are $150,000 for 2 years. Of course, we have to consider the after-tax implications. So they give us the tax rate at 30%, and the company's weighted average cost of capital is 9%. The machine will be fully depreciated on a straight line basis over the 2 years. And Boulder's financing option for the lease, okay, let's look at that, are a bank loan at 10% interest rate, or leasing the equipment for $92,500 a year with lease payments due, and they give us each year, and then they give us the relevant factors: present value of an annuity at 9%, present value of an annuity at 7%, and present value of $1 at 7%. Now, when you first look at this question, you sit here and you say to yourself, well, why am I sitting here and considering 7%? Well, let's just clear that up right away. If we have what, a 10% interest rate, the after tax, and if it's a tax rate of what, of 30%, is going to be what, 10% minus times 0.7. That's going to give me, or the way I want to do that, they gave me the 100%, right? The 1 minus the 30% is a 70% after tax cost of financing. So that's where I got the 10% times the 70% gives me the 7% that I will then be using for, obviously, the financing decision. Okay. All right. So that's just where that's coming from. And that's why they gave me those factors. So I come over and I'm going to determine the operational benefit of the project. The operational benefit of the project is $150,000 after tax, guys. And this gets a little confusing the way they show that, because you're like, where'd that 1.79 come from? That's the, that were actually, what I think you might be asking is, where that 105,000 come from? That's 70% of 150,000. Took me a second to figure that out when I was looking at this. Where they get 105,000? It's 70% times 150,000. The 0.1759 is what? That is coming from the information up here, which was the present value of an ordinary annuity at the 9%. 9% was their cost of capital, right? So we have to use that to discount those cash flows coming in, okay? And so they give us this 184,000. Now, the way I look at this 184,695, I should consider it both when I look at the financing option for borrowing to buy the asset, or the financing option for what? For the leasing option. Okay, so that's basically what they're sitting there and saying, okay, you have to choose between these two options. Now, anything with a negative net present value, I'm not going to do it. I know that. Okay, so then I'm going to go ahead and I'm going to discount now the cash outflows, considering that cost of the capital here, which is at this 7%, or the after-tax cost of the financing here, which is this 7%. I showed you how to get that. So they go ahead and they have the depreciation tax shield, and they have what? They have the using straight line for the 2 years, and then they have the scrap amount after tax. So they pick those two numbers up, and then they go ahead and they discount those two numbers using that 7%, because that's the after-tax cost of the financing. And so what happens is they come up with the 200,000 minus the or add, I guess you could say, the 28,050 and the 41,000, because they're going to sell that, get that back. We compare that to the money that's coming in, and this gives me a net present value here of 54,212. Now, when I look at the leasing consideration, now it's what? Now it's the 92,500 that I'm going to have to pay for the lease payments. 92,005 times 70% gives me 64,750. Again, 1.935. I have to use that 7% now, because they are basically using an annuity for those two payments. So I can now pick that factor up at 7%. And so I go ahead, and those payments are an annuity because there's two payments that they have to make there. And so when I do the math on that, I get 125,291. And again, they go ahead and compare that to this 184,695. This had the higher net present value, so I go ahead and I select the option of leasing this. So I like to stick with, when I look at these, which one has the higher net present value. Question? They say the lower cost of financing. Okay, but I'm not going to take any project with a negative net present value, so I like to look at them. Both have a positive net present value. Take the option that gives you the higher net present value. Okay, all right, good. Let's go ahead then, and let's jump over now to the other two methods. Remember, we said earlier that we're going to look at 3 capital budgeting tools. We've looked at net present value. We've seen how we can use that in different scenarios. We are now going to focus in on the internal rate of return. Then we'll do payback method, which you should pray that you get 50 questions of payback method on the exam, because that's the easiest of the 3. Okay. Now, what we do with internal rate of return, okay, in the internal rate of return method determines the present value factor that yields a net present value equal to 0. Okay. Now, the internal rate of return focuses on the decision maker on the discount rate, which is the present value of the cash inflows equals the present value of the cash outflows. Now, you look at that and you're like, okay, do I really understand what's going on here? So what happens? What they're basically saying is that if you take the net cash flows, okay, and you multiply those by some present value factor that equals the initial investment, that is the same as saying what? The present value of my cash flows equals the initial investment. That's basically saying that the what? Net present value equals 0. Because the cash inflows, the net cash inflows, I should probably say, the net the net cash inflows, John, is the right way to write that. The net cash inflows times the present value factor means that the net present value is 0. Okay. Now, once you know that, then all you have to do is divide each side by the net cash inflows. So you take the initial investment, divide it by the net cash inflow, and that yields the present value factor that will cause the net present value to be 0. And then you simply find the factor, the percent, the interest rate that is associated with the number of periods in that present value factor. That tells you the internal rate of return. And then you compare that to the hurdle rate. The hurdle rate is determined by the weighted average cost of capital, possibly. And what? If we are more than that hurdle rate, we take the project. If we're less than that hurdle rate, it's not meeting our minimum rate of return, we reject that project. Okay, so that's basically where we're going. I'm just showing you how we're going to use the come up with the numbers that we would use in a calculation there. But as I just stated, accept the project when it is greater or equal to, they seem to be leaving out the notion that the thing would exactly equal 0. Okay, so except when the internal rate of return is equal to or greater than the hurdle rate, projects with an IRR greater, accept, reject if the internal rate of return is less than the hurdle rate. Okay, and so you can go ahead and flashcard that. Okay, now, again, limitations of the IRR cash flow generated by some investments are assumed in the internal rate of return analysis to be reinvested at the internal rate of return, which may or may not be true, because once you get those cash flows to continue to get that return, you'd have to reinvest them. And then there is inflexible cash flow assumptions, which is why we said that the net present value method was more generally accepted and used. The timing of the amount of cash flows used to determine internal rate of return can be misleading when compared to the net present value. Therefore, IRR is less reliable than the net present value method when there are alternating periods of net cash inflow. We saw how we were able to adapt to that in the net present value method. You really just assume that the cash flows are even. Those cash flows would have to be the same, and I say even, the same every single year in order for the internal rate of return to be giving you a meaningful analysis, and that's probably not very realistic. So flashcard that, and let's go ahead and take a look at now the payback method. Okay, payback method, as I said, you should pray that you get 50 questions on the payback method because it is the easiest thing in the world. You simply take the net initial investment, divide it by the average incremental cash flows, and that gives you the payback period. Now, they make a big deal out of, well, what happens if the cash flows differ from year to year? Well, then you're just going to have to take out your calculator and analyze how long it's taking you with uneven cash flows to recoup the investment. And then if that is shorter or longer than the required payback period, if it's shorter, accept the project. If it's longer, reject the project. And we'll take a look at a question like that here in a little while. Okay. Now you come over and let's look at advantages. I'm not going to even go through the problem with you guys because you're going to see when you look at the actual class problem that we're going to do together here, and that you're going to do, and I'm going to show you. Well, I'm going to show you, and you're going to work it on your own. You're going to see how easy the payback method is. Advantages of payback method: easy to use, and that's a huge advantage. And emphasis on liquidity, because we're really focusing on how long it's going to take us to recoup our investment. Okay, so you can go ahead and flashcard those advantages, disadvantages. Now, the limitations you can flashcard is that it's ignoring the time value of money. It's saying a cash flow 3 years from now is just as valuable as a cash flow today or tomorrow, and that's not true. Project flows occurring after the initial investment is recovered are not considered. Reinvestment of cash flow is not considered, and total project profitability is neglected. Now, one way to get past the problem of time value of money is you could discount the cash flows in the payback method. And so I'm not going to go through this question with you either. I'm trying to point over to the next page. Of course, I have to scroll down to get to the next page. But when you look at this example over here now, okay, all they do is they take the cash flows and they discount them, and they use that to figure out the payback. Not a big deal, okay? And that at least takes away that disadvantage, the ignoring the time value of money factor for the payback method. Okay, now you're looking saying, John, geez, you blinked and you're done with the payback method. And yes, that is the case because, and again, I'm not going to show you how to calculate the factors. That's nonsense. If they give you a question where they ask you to calculate present value factors, pick whatever letter you haven't picked a lot and move on. Don't sit there on the exam and try to calculate present value factors. They're not going to ask you that. And I don't know why Becker keeps insisting on turning us into mathematicians. Okay, so let's just go ahead and let's take a look at these questions. I think they're all the payback method, and my major goal here is to show you how easy this is. Okay, so let's just go ahead. And for some reason, my cursor seems to want to work better with Zoom when I'm not in full screen mode. So let's just look at this first one. Okay, guys, I'm going to go ahead and I was kind of waiting to see if we'd get a higher participation rate on this, because we really shouldn't be taking 3 minutes to answer a question like this. But when we look, it looks like 71% of us got it right. But let's just take a look at this. And which of the following statements about investment decision models is true? Discount payback rates take into account cash flows for all periods. No, as we saw, that's one of the disadvantages, in that it doesn't consider cash flows after the payback period is calculated, right? The payback rule ignores all cash flows after the end of the payback period. Yeah, because we're making the decision entirely on whether or not we have hit the payback, right? Net present value method says to accept investment opportunities when their rates of return exceed the company's incremental borrowing rate. That's a nice little nonsensical statement. The internal rate of return rule is to accept the investment opportunity of capital greater than the internal rate of return rule is to accept the investment if the opportunity cost. I mean, I can't even read that one. It's so stupid. Okay. So obviously, B is the correct one for us. Question? Okay, let's go ahead. Here's one that relates just to the payback method. Let's look at that. Okay, looks like most of us have had a chance to look at this one, so I'm going to end the poll. And good work, guys. Everybody got this right. Just about everybody. It ignores the time value of money. Of course, you could use the discounted payback method, but they didn't say that. They just said the payback method. So it ignores or does not consider time value of money. It is the time required to recover the investment and earn a profit. No, we're just taking the initial investment divided by the net annual cash flows. That's telling me how long it's going to take to recoup the investment. There's no profit consideration. Is a measure of how profitable one investment project is compared to another? No, it simply tells you how long you're going to take to recoup the investment. The salvage value of the old equipment is ignored. No, if I'm going to get some money back from selling the old equipment in a replacement, that in effect is decreasing the initial investment. And since I divide the initial investment by the net annual cash flows, that would shorten the payback period. So no, that is not correct. Now you would ignore the salvage value of the equipment that you're thinking about buying under the payback method, because think about that. If I'm going to have to sell the equipment to recover my investment, that's a horrible business decision. Okay, so that you would ignore the salvage value of the equipment you're thinking about getting in the evaluation, the new equipment, if you will, if you're thinking about using the payback method. Okay, good. Let's look at this one. And what I like about this one is it does a nice job of considering many of the factors that we saw in our discussion from the text about payback method. Okay, guys, I'm going to go ahead and end the poll on this one. So take your best shot. Okay, we're heading up on 3 minutes with this question. And looks like we did pretty good on this one. 78, almost 80% of us got it right. So let's just take a look at this one, though, and I think you're going to see how pretty easy these payback questions are. So they have a payback period of what? 3 years, and we're going to evaluate these 3 different projects to see, hey, will they pay back in 3 years or less? And so the first one is pretty easy, in that you take the 10,000, okay, that's the initial investment, you divide it by the net cash flows, and since it's the same each year, which is sort of what is commonly assumed with the payback period, it would take 3.33 years. Since that exceeds the 3-year period, it's a no to project A. Now, project B has an initial investment of 25,000. You know, they make a big deal. Oh, well, if the cash flows are uneven, you're going to have to, and they go on and on. Well, let's just, you know, the way they describe that, let's just look at it. 25,000, 15,000 comes in year 2, 15,000 comes in year 3. Yeah, by year 3, we will have collected what? 30,000 on that. We will recoup our investment in less than 3 years there. And so the answer to that one is, yeah, we're going to do that. And then you look at the next one, and again, this one has, you know, even cash flows in 2 years. I mean, I guess I could do this if I had, you know, if I couldn't do that in my head easily enough. The 10,000 divided by the 5,000 gives me 2 years. Yeah, I'm going to go ahead and do that one. So I would do projects A and B and C only under the payback period, payback method. Very simple. May you get 50 questions on the payback method. Okay. All right, guys, we're going to get out a little early tonight. I kind of thought about spending the balance of this time looking at the start of chapter 3, but I think I'm going to have pity on you, take mercy on you, and not make you sit here and start a new chapter tonight. That means that you've got to balance the time to go to bed early, or do something crazy like spend some time with your family or something, or your, you know, friends, whatever here, and then you know, get to looking at those things tomorrow and get to finishing up chapter 2 tomorrow and over the weekend, and then we'll hit chapter 3 on Tuesday next week. Okay, questions, guys? All right, if there are no questions, I'm going to stop the recording. And I'll have that posted up here pretty